Assalamu alaikum and good morning, everybody. Thank you so much indeed for joining us today. I hope this group life insurance webinar will be something valuable for all of you. Allow me first to brief you quickly about the federation. The federation has been established in 1964. And currently, we are having more than 224 members from 50 countries in Africa and Asia, and a couple of countries in Europe as well. The main purpose of the federation is to encourage collaboration among members so that the insurance companies and reinsurance brokers, service providers all work together to the best interest of their companies and in the whole industry. We also provide market statistics and market information, promote the best practice of insurance industry, and I'm proud to be here working with the Insurance Federation for the past 3 years. Now, the host of this webinar is Saudi Re, and I would like also to brief you quickly about Saudi Re. Saudi Re Insurance Company has been established in Saudi Arabia in 2008 as a fully fledged reinsurance company. The company writes proportional treaties, non-proportional treaties, facultative business, life and non-life, all lines of business, almost all lines of business. And they are operating in more than 40 countries in Africa and Asia, as well as the Lloyd's market. Saudi Re maintains an A3 Moody's rating, as well as A- by Standard & Poor's. They have also had a paid-up capital of $300 million, and their written premium in 2023 has exceeded $425 million US. Now, the most valuable member and most valuable component of this webinar is Dr. Tanuja Gore. I had the pleasure to work with Dr. Tanuja in Saudi Re when I was serving in Saudi Re, and she was one of the really, well-dedicated, well-educated, very humble, very knowledgeable person. So allow me quickly in 2 minutes to give you a quick brief about Dr. Tanuja. She is a qualified medical insurance and medical and insurance professional with rich experience and functional expertise in life and health underwriting, product development, and reinsurance. She graduated from Maharashtra University of Health Science in India and acquired a fellowship from the Insurance Regulatory and Development Authority of India and a diploma from the Chartered Insurance Institute of the UK. Dr. Tanuja has held key positions in prestigious companies such as ICICI, Prudential Life Insurance Company, HDFC Ergo, General Insurance Company Limited. This, who knows the Indian insurance market, knows that these companies are among, actually on the top of the list of the most disciplined and most successful insurance companies in the market. She transitioned into the insurance sector when she held the current role as manager of the Life and Medical Underwriting Department of Saudi Reinsurance Company at its headquarters in Saudi Arabia, in Riyadh. And she plays a pivotal role in diversifying the reinsurance business beyond the Middle East and GCC into Asia and Africa. She is an active member of the Protection and Savings Subcommittee with the Insurance Authority of Saudi Arabia, and contributing on new initiatives and product development in the Saudi market. I would like to give a big thanks to Dr. Tanuja for dedicating her time and sharing her from this presentation, and from directing some of the questions to Dr. Tanuja. If you have any questions, please, you can send them through the chat, and I will try to look at them and allow me on your behalf to direct them to Dr. Tanuja one by one, or at least I will try to group them and direct these questions to her. We are currently having 45 participants logged in, so we expect another 45 or 55, because actually we have registered around 100 people interested in this presentation. Dr. Tanuja, without any further, delay, thank you so much indeed for being with us here. I'm personally honored and privileged to have worked with you, and the floor is yours, Doctora.
Likewise, sir. Thank you very much. That was a very kind introduction. I am delighted to be here today with all of y'all. Yes, sir. It was a pleasure to have known you for many years now. Thank you for this opportunity. The intent of today's talk is to have a very fruitful and insightful um, uh, vision of this interesting topic, which is group life insurance pricing. Before we
Thank you.
start, just want to know whether I am very clearly audible and whether the slide is up for viewing.
For myself, I can hear you very well, and I can see the slides as well.
Perfect.
Yes.
Perfect. So we will jumpstart into our session this morning. Thank you, everyone, for joining in, and hopefully, we will grow in this size of the webinar soon.
Thank you, Doctora.
Yes. So let's begin. We would go quickly into a warm-up session because I understand this is a mixed group. I have my colleagues, peers, seniors, as well as our young friends, the young underwriters. So we will speak about some fundamentals, warm up with some basics, and then deep dive into the actual subject. So it's good to start with some fundamentals of pricing. The word pricing is a very intriguing word. Most often, a lot of people might think of the word pricing as a very mechanical act. You add up some numbers, you load up some factors, and voila, you have a price. But if that was the case, my presentation would be more of a demo, a demonstration of a pricing tool where I would show you, okay, data entry and then data output. But thankfully for all underwriters, it's actually a more detailed process. It's I would say it's a mix of science and art and the entire process of underwriting. And the price is in fact the byproduct, the outcome of the entire process of pricing. So what you see here on the screen is a fine balance between price and value. And as underwriters, this is what we should aim to achieve, a fine balance between what is it that you're pricing, what is it that you're offering to the customer. Talking about life insurance, we know that we are not in a business of selling any commodity. There is no touch and feel. For example, we are not into the business of selling a bar of chocolate or a bottle of perfume, which you can touch and feel. In fact, it's safe to say that we are in the business of selling a promise. If you look at life insurance, what really it is somebody is paying you money to deliver something which will happen only once he ceases to exist. So you can imagine that life insurance is a beautiful product of trust. One is actually entrusting life insurance after the death of the person. So the golden question is, how do we price a promise? So these are some fundamental key corners on which our pricing activity is based on. Number one, you should know your product thoroughly. What is the product that you're pricing? If you don't know your product, how would you end up putting a price to it? You should know who your consumer is, who is the end user, and you should know the environment in which you are operating, your market. So these become like a holy trinity to come up with any pricing. And as underwriters, we are responsible for developing a book which is sustainable, which is profitable, and you're running a show, right? It comes with a cost. So your pricing will also incorporate various types of costs, variable and fixed, and obviously a profit margin to keep a profitable and a sustainable long-term business. So the agenda today would be to, go around this particular picture and cover all the aspects of a fine balance of price and value, understand the product, consumer, market, and the various factors, the loading factors of a pricing. Right. For the benefit of our young underwriter friends, let's go back to this vision. What you see on the screen is almost a journey of any human being existing on this planet. You see, this journey is not a straight line from point A to B. It's a maze, right? Your consumers, your life insurance profiles are all these people. So if you see the picture in the box here, it's different phases of life, right? You would have the beginners, the starting out phase. This is typically a phase where one would be literally planning for his financial future, right? One would take up a new job and eventually grow into a family, get married, have children. So, all these are essential milestones where one has to plan their financial net. Moving on from a growing family phase, you reach a midlife phase where there would be purchase of house, there would be estate planning, you would soon approach retirement. And of course, nowadays there is everybody wants to save for the golden years. Everybody wants to have a very comfortable retirement and beyond life. So one needs to be financially well balanced to go through this entire journey of life. And therefore, the answer is who needs insurance? Who needs life insurance? Whether it's too early, whether it's too late. The answer is everybody, from young adults to retirees. Everybody needs life insurance. And that's what you will see as an underwriter. So this is just what I spoke, the details of how one would plan his or her journey depending on the life stage and depending on the financial obligations. What I want to draw your attention here is this life insurance typically would come in two formats: individual and group. We are all familiar with this, and what I've tried to put up here is just the basic differences between individual and group life. What we are going to focus today is the group life, which is the green box. So, quickly, individual is something where I myself plan a product for me depending on my specific needs, go and buy a policy just for myself to secure my life or secure the future of my dependents. And it can be customized, there could be embellishments to it. So it's a different genre of product. Whereas a group product is where there is one single policy and covering multiple lives. So it's a contract between a corporate company and the life insurance company, very different from an individual. Typically, these products would be lesser embellished, more simpler as compared to an individual product. Premiums are paid by your employees. And therefore, these are the main differences. The exclusions would be fewer, the product style would be fewer. And that's what we are going to see, that, how do we price a group life product. So now that we've kind of got a warm up of the profile, we'll see what are the typical and the most popular group life products. The first of the kind, which all of you all would have seen, is a group term life insurance. This is typically an employer-employee kind of a product where the employer would secure life insurance on the employees. It's almost a huge retention tool. It's one of the major attractions for hiring a good talent. And it's just incidental, nobody is joining a company to get insurance. So the chances of anti-selection are low. In the due course of our presentation, we will deep dive into anti-selection and how it impacts the pricing. So this is product number one, typical product number one, which is group term life. The other product which we typically would see is a group credit life insurance. Now, this is a unique product, different from a regular employer employee group term life product. This is a creditor and debtor relationship. So, as underwriters, what you will look at is a group of loan borrowers. The intent here is not like an employee benefit or an attraction from the HR or a retention tool. In fact, it's straightforward. It's safeguarding the financial interest of the lender or the creditor or the bank if something happens to the loan borrower. And another unique feature is the sum insured, because the sum insured also is one of the key factors impacting your pricing. Here, because it's a loan, it is not a static sum insured value. In fact, it is changing almost at a very high frequency, almost every month, because as and when the loan installments are paid back by the loan borrower, the sum insureds decrease. So it's a dynamic sum insured that you will watch as you know, as and when you do the pricing. And since it's a widespread group, people from all walks of life, different backgrounds would be a part of a bank's loan portfolio, one needs to be a little more cautious, requires close monitoring, and maybe a tad bit higher underwriting vigilance. So, yes, now we've understood what is our profile, what kind of people are you going to look at, what kind of products are you going to look at. We'll have a quick go at the consumer profile. We just spoke that it would be workers or employees. It's a part of your employee benefit package, and creditors would cover loan borrowers. So, what is the nature of the setup of these groups? It could be right from employer employees to non-financial banking sectors to professional groups to microfinance institutes to banks. These are some top of my mind nature of groups that you would see. Now the question is, why is an employer wanting to put his hand in the pocket, take out money, and buy something for the employee? Well, what's the gain for the employer or the creditor? As we saw, this is one of the greatest tools for attracting and retaining top talent. If you Google nowadays, in certain markets, I know of a big company who did a survey in Asia, and they asked a random group of people, what is it that you like about your job? Obviously, number one was salary, right? At the end of the month, paycheck is my biggest motivation to go to office every day. But surprisingly, the second and very high on the likability of your job was the insurance. So a lot of people said, I go to office, I am happy with my job because of the group life insurance that I'm getting. So it's kind of an employee well-being and a source of financial security. How does it impact the interest of an employer? Is because it's a natural boost to the employees' morale. You will have happy employees, more engaged and productive. On the other hand, it's a huge cost save, because as we progress in the presentation, we'll see that price war and rates is something which is at times a make or break situation to secure group term life businesses. So yes, it's a quite a cost save for the corporates. You've seen that some of these group life insurance also come with wellness programs or value addition programs. I'm sure most of you would have attended annual health checkup in your offices. It's all part of the provider from your life insurance insurance company. So it's good, that the company is taking care of the lifestyle of the employees. And of course, this is a major tool of risk transfer. So yes, we've got an overall idea of the profile that we are talking about and the product that we are talking about. So for easy reference, this is a slide where you're seeing the contrast between the group life and the individual life, the various aspects of how the employment, the contracts are done. So if you see, the contract owner in a group life is not yourself, but your employer. He's the master policy holder. One should always have the status of an employee. If somebody resigns, he no longer remains a part of the group life insurance. The process is a simple enrollment. We saw that the premiums are coming out of the pocket of the employer. We saw that these costs are much more economical as compared to buying an individual policy, which is more specific. It would be based on various factors of an individual. The coverage in a group life is to an organization. Importantly, the sum assured. And later in the slides, we will see the impact of sum insured or sum assured on the pricing of group life. Sum assureds could be of various formats. It could be a fixed sum insured, depending on, let's say, the top management is fixed at 1 million, the lowest executive level is, let's say, 50,000. Or it could be salary based, multiples of salary. Let's say 24 times the monthly basic salary of an employee is the sum insured. At times, it could be a combination of salary and capped at, let's say, 1 million as the maximum value. Or you could also see sum insureds which are uniform. All employees flat sum insured of 100,000. So this also impacts your pricing, that how is the sum insured distributed. And mind you, the combination of all these aspects would drive your entire pricing process. Medical underwriting. We've all heard about the process of a detailed medical underwriting in individual, but whereas in a group, there is almost nil to minimal medical underwriting. And we'll see one of the important aspects of this while doing the pricing. We know that the customization limits, the customization options for a group life are very limited because it's your policymaker, your HR and admin, and the top management who decides what kind of group life product you will have. It's not that you get asked what do you want as a product. But we will also see later that nowadays even group life products are getting customized and how it impacts your pricing. Uh, Importantly, the term of the product. Group life is typically a 12-month contract. It's an annually renewable contract, whereas individual is a long-term product. So why this is important to know is your entire pricing game changes, because if you have something which you need to review after 12 months of the program running, you have many other aspects, while doing or looking at the data, right? So I thought, it's a good idea to put this two products across each other so you always remember the highlights of group life. Moving on. Now that we are almost familiar with the product and the nature of the process involved in this product and the profiles, what do we do before even beginning to price? It's the profiling, very, very important. We have all seen these two words, insurable interest and anti-selection. I'm sure we've all heard about this. And why do I bring this on the table is because when you're looking at a group life program, You know that there is a sure insurable interest. We saw a couple of slides back that, why a employer-employee relationship exists, or why a creditor-debtor relationship exists, is because there is an insurable interest. So mind you, the policy, the insurance cover itself is incidental. There is no express purpose of people coming together just to, there are no 50 people joining a company just with the motive of, buying life cover or securing life cover. So it's just incidental, which is a good thing for you. The intent of the group is clear. Also, we know that your guys, the folks you're looking at, are full-time employees. So typically only healthy people would be a part of the full-time working group. Nowadays, all corporates conduct a pre-employment health screening. So you know that you're looking at a good profile. Since one cannot really choose the sum insured, it's a good thing for you as an underwriter, so that there is no anti-selection, and it's a compulsory plan. So by virtue of you getting employed, you automatically become a part of the group life, and when you resign or retire, you automatically come out of the group. So it's a very organic coming in and coming out, and therefore there is a very high insurable interest. What you should look out as a red flag in the group is sources of anti-selection. Do you think there are unhealthy employees in the group? Do you think there are part-timers or contractual workers who do not have a long-term interest? Typically, one would come and join a company just to deliver a project for 1 quarter, and he or she is moving out. Watch out for people with long absenteeism from work due to long sickness periods. Watch out for retirees, pensioners, trustees. These are guys who are old, not in full action, not working full time. So, yes, profiling, it becomes very, very important, right? So now we are kind of building the whole picture of, what is it that we are pricing at. We'll move on to something very interesting, which is riders. Now, we saw a couple of slides back that group life is more or less a simpler product, but nowadays they are upping the game. A lot of corporates want to secure the financial burden, not only in the event of death, but also due to many other um, eventualities which would impact the finances of a family. What are these? If somebody doesn't die, but still the health is affected. So there is the whole array of riders that's available and that the corporates want to attach, right from an additional cover for death due to an accident. So typically an accidental death would be something absolutely unforeseen, yeah, and absolutely unfortunate. There are disabilities, various kinds of disabilities, you name it. It could be a total permanent or a partial permanent or even a temporary disability which will impact the finances of family. Neither is somebody dead nor disabled, but still having an impact is due to some severe illness, such as critical illness or terminal illness. Uh, what about medical expenses due to accident? The list goes on. I just tried to put some examples here. There are markets where they offer daily hospital allowance. For every day spent in the hospital, there is a fixed amount which is paid as a insurance benefit. Some countries or some markets also have the last rite expenses or the funeral expenses. So your pricing tool should be fortified to handle these embellishments, because this is the new trend. Besides the death coverage, these are the riders that you will see as an underwriter, and you need to understand the pricing for these eventualities as well. Most critical, as underwriters, you should be fully aware of the specific definition of the rider, because only once you understand the definition is when you will be able to price it. When you sit and develop tools with your actuaries, you are the one who will guide the pricing tool rates. So, for example, critical illness, one of the most popular riders attached to a group life insurance. Do you know that you could see a list of critical illness as small as, let's say, 5 critical illnesses, such as heart attack, stroke, major organ transplant, renal failure, paralysis, right from a small list to I have seen a list of more than 35, 50, 85. So different markets kind of, add on to the list. So you need to know your CI has how many diseases that you're covering. Is your CI rider functional on a standalone basis or an accelerated basis? What is a standalone critical illness? It's where there is a over and above, it's a separate sum insured paid when one get diagnosed with a critical illness. Or is your rider as a prepayment, is it on an accelerated mode where, part or a percentage, let's say 50% of the life sum insured is getting paid as a prepayment because of the diagnosis of critical illness. So what I'm trying to tell you here is that you need to be very, very thorough with the policy wording, with the definitions of the riders. Let's take another example of a rider. Disabilities, these are the top common riders that you use. Now, disabilities would be multi-layered, as you can see, TPD, PPD, TTD. So you need to know what this stands for, at times, disability could be arising out of an accident, pure accident, or maybe due to an underlying sickness, or it could be both, accident and sickness both. At times, your definition would say that, okay, when the disability is established, one should be incapacitated or unable to continue her or his own occupation. Only then we will pay the disability claim, or he or she should be incapable of doing any sort of occupation. So yes, I mean, go deeper, go try to understand what exactly is your rider, what is the definition of rider, and your pricing tool should have these different options to price. Coming to something which is not permanent, let's say it's a temporary but total disablement. Deep dive into the definition. Is it a percentage of the base sum insured? Are you going to pay weekly salaries? If yes, how many number of weeks? Is it, let's say, 52 weeks maximum or 104 weeks maximum? And your pricing tool should have the combinations of all of these definitions. Otherwise, your pricing tool and your approach towards pricing is unfortunately deficient. So yes, point to be taken away from this slide is that riders are important and one needs to be familiar. I thought it's very important to also talk about one more rider, which is usually seen in this region, which is WC, the Workmen's Compensation Act. So in some countries, the WC law, it sets minimum compensation requirements. It could be different from international scale. Idea is that your tool should be fortified to handle this rider as well. This is just an example of the Kuwaiti WC category. So what is workman's compensation? It's covering any kind of accidental death or disability whilst somebody is at his workplace. So it could be a time window of 8 hours. So moral of the story, riders and all sorts of riders, and their definitions are key. They are essential for your pricing, right? Moving on to a very important thing. So in the comparison between group and individual, we saw medical underwriting, and this, the golden word, FCL, free cover limit, it becomes one of the most unique selling points, as they say, USP of group life. I thought, a green signal is the best depiction of an FCL situation. So what is FCL? It's basically no questions asked. It's a free cover limit. The name itself gives it away. In a group, you do not ask for any level of medical health evidence or proof of health up to a certain age and up to a certain sum insured. And this is a major and a significant cost and time saving feature for the corporate, right? I mean, the idea is to have something easy, something, a quick enrollment, okay? And we saw some time back that already as employees, they undergo pre-employment checkups. So yes, free cover limit makes a lot of sense. But as underwriters, it's important to kind of know what are the various factors involved in free cover limit. It depends on various factors, some of which are the size of the group that you're looking at, the nature of the employment, and we will see how different kinds of industries would impact the health, the premiums of your group. What is the average level of benefits among employees? And importantly, how has the group behaved in the past? What does the historically claims data story narrate? So in smaller groups, typically they would have lower FCLs, but you have to be extremely careful about anti-selection, because typically in a smaller group, the top management or the big bosses would be the policymakers, and they would wish to have FCLs for themselves. They would possibly be in poor health. So be very cautious about setting up the levels of FCL. Like riders, even a high free cover limit is one of the uh, key game changers or major offering of corporates, especially in developed markets. So idea is to ensure that you as underwriters are ensuring this kind of a limit. It's making sense, because at the end of the day, the cost is borne by the life insurance company. So that costing also impacts your final price. All right. Perfect. So we've gone through the profile, the product, the various riders, the free cover limit. So all in all, we are talking about the employee, right? But there is another interesting aspect to the group life: dependence. At times, it's not only the employee whom we are going to underwrite. There are some corporates who invite the family also to join. When I say family, it's the immediate family, which is the spouse and children. So how do you handle that? Because what is the insurable interest between the employee's wife and the company? But yeah, as I told you, this is one of the major attraction tools to retain talent. And I would be a happy employee if my spouse or children are getting covered. So how do we look out for a price? Yes, make sure these points are in your mind when you do an underwriting for a group, which includes dependents. No points for guessing. The coverage, the sum insured of spouses and children, cannot be more than the sum insured of the employee, right? It has to be either definitely lower or equal. Almost, there is a greater level of anti-selection because, there is no direct insurable interest. So typically spouses are asked to, give proof of good health. Children, why would children be automatically covered? So when newborns are covered, okay, it makes sense. But somebody who's at a university level, who's financially independent, doesn't make sense for that child or that young adult to be a part of the group as a dependent, because he's financially he's basically the maze that we saw in the beginning. He's at the stage of starting out, so he himself will do the planning for his financial future. So age limits, especially for dependents, is important when you do the pricing. The rates for these dependents should be more conservatively looked at, dealt separately, right? So this is an overall package that you're going to put your hands into while doing the pricing. Right. Now that we are, all our ingredients of cooking the price is ready, we need to do the quality check of these ingredients, right? As they say, data is the king. On a lighter note, there is something called as GIGO, garbage in, garbage out. If your ingredients are not of top-notch quality, your end dish is going to suffer, right? So you as underwriters will receive data for the pricing. Check the quality. Check these points. Is your data showing authenticity? Is it authentic? What is the source of this data? Is it a reliable source? Can you comprehend the data? Do you think the data is complete? How will you know whether complete or not? Because you will go back to the previous aspects. Okay, are the dependents covered? Are the riders covered? What are the sum insured definitions? So on and so forth. Various factors that define completeness. Is your data accurate? And importantly, is it giving you clarity? So these are bare essentials even before you use the data for the actual maths, the actual act of doing the price. So remember this mind map or this wheel, the various data dimensions. As I said, consistency. You as underwriters would receive data from various sources. You could receive it directly from the corporate. You could receive it from a middleman, a broker, an intermediary. So if you have multiple sources of data, check whether it's consistent. It's always a good idea to go through the different data sheets and check whether they're asking for the same thing. Are the number of members the same? Is the average age the same? Is the average sum insured same? Is it looking different? Go back and ask questions if there are any inconsistencies, because you don't want to start pricing with something that's compromised, yeah, because you will never be a confident underwriter if you are not confident about your data. As I said, check for the completeness, check for timelines, extremely critical factor for the data. When is the life insurance policy beginning? Is the data most updated? Are the claims most latest? Or there is a huge timeline gap? Because if your risk is starting in a month and your data is showing results or claims or updated employment status only for the last 6 months, you are not looking at a complete data. So timelines of the data are extremely important. Check for duplications. Is your data unique? Are there any duplications? Are there any misouts? Check for integrity and keep validating. So this slide is again one of the backbone slides for proceeding into the actual act of pricing, right? Before we jump into the second part of the pricing activity, now that we've completed the product and the pricing and the data checks and balances, I'd like to just take a minute and check whether the pace is fine, Mr. Momin, whether I was audible, whether the slides were clear.
Dr. Tanuja, I am enjoying what you are saying. I'm learning again as usual. It's very, very important what you have just relayed as the setting the scene for starting the pricing process. And I have personally got involved in some of these data integrity and data checks. And sometimes you find that the client or the policyholder will send you some information, or the broker. And when you look at the information, you'll find someone who has a claim of, for example, 5 million, whereas the maximum sum insured was 1 million. So you
Right.
wonder whether this is correct or not, and then you go back to the source of the information to validate the information and so on. So all these things, and particularly as Dr. Tanuja mentioned earlier, we need to understand the component of the product, the offering, the riders, the wording of the rider we are offering as on top of the life insurance. What does it cover? What doesn't it cover? Sometimes we have seen, as also mentioned by Dr. Tanuja, that we have in the for example the workman compensation, and you calculate your claim amount based on the international scale. Whereas in some countries, the law force you on a different compensation. So all these things, to avoid arguments or disputes or dissatisfaction, you need to understand the market you are writing the business, the client, the type of the job of the people working. Are they working in offices or working on construction sites or something like that? Because these make big difference at the time of the pricing. So, Dr. Tanuja, every slide so far you have mentioned, you or gone through, I feel that I'm learning again. I'm gaining some knowledge. Your voice is very audible. Your way of presenting it is marvelous, as usual. Thank you,
Thank
Doctor.
you. Thank you. Thank you, sir. All
Please.
right. So I thought this was like a beautiful juncture, before we jump into the act of pricing. So now that we are ready with the data, we will move to this particular slide, which will now give you an overview of the multiple factors in your data that is going to impact the final price. Now, mind you, what you will see on this screen right now is purely for illustration basis, because each and every risk is unique, right? So everything that you receive as an underwriter, you will have to completely view it with a fresh set of eyes, right? So let's jump in. These are some various factors which will impact your group life insurance pricing. All right. As I said, this list is just for illustration, but yeah, I think it covers most of the critical aspects or the factors that impact the pricing. So you can see age, gender, the health status, the group size, the industry class. We touched base upon the type of product. Are dependents covered? Are the riders covered? What are the add-ons? What is the definition of the sum insured? Important aspect, currency. Some of us are dealing in multi-currency policies. Some of us might be looking at multi-country or multi-location policies. So how does a currency impact on your pricing? Very, very important. Territories or countries. Your group life policies are spread across what number of locations? Very important. What kind of historical claims? How has the group performed so far before turning up in onto your underwriting table? Are you looking at a completely virgin scheme, a new scheme, or this is a ongoing renewal. And of course, we also saw free cover limit. So as I said, and I want to highlight that this list of factors is always illustrative. It's not exhaustive because each risk is unique. Now we are going to, I'm going to try my level best to give you an insight of all these factors and how they impact the price. So top of the table, you see the age and the gender, because, we are talking about human life, and, human life, every morning you wake up, you're aging, right? So we will touch base upon age and gender first. And for that, we will talk about two very important words in the life of a underwriter: mortality and morbidity. I'm sure you've all heard about these two words, and we will have a quick glance at just a crude definition. Uh, the word mortality relates to the death aspect, and the word morbidity relates to the disease aspect. So when I say mortality rates, it's the frequency of deaths. And when I say morbidity rates, it's the frequency of disease. So a crude mortality rate in a given population is basically the number of deaths in a given time span uh, in a particular population. So let's say you can Google and see the mortality rate of Egypt or India or any country. It talks about the economic status of a country. The mortality rate talks about the healthcare situation in a country, so on and so forth, right? So mortality is the backbone of the pricing tool. Your entire pricing activity stands on the sturdiness of a mortality table. We've all heard this word, mortality table. Now, mortality table is the one that will determine your premium rates. Yeah. In some markets, these mortality tables are closely monitored, watched, regulated, and standardized by the regulators. So there are some examples that I put. Indian Assured Life's mortality, or LIC, the Life Insurance Corporation of India mortality tables, that's used as a gold standard to kind of monitor and standardize and regulate the mortality rates of life insurance. LIC has been in operation for over a century. In Tunisia, the regulator operates on TD99 table. In fact, I just added up this very recently in the slide that FRA, the Egyptian authority, has come up with the first Egyptian mortality table in 2023. So that's again an interesting development. And of course, your pricing tool, as I said, people are aging, countries are changing, world is changing. So regular monitoring and updating this tool becomes key. It's basic maintenance. Your mortality tables should be monitored, updated regularly. What you also theoretically need to understand that these mortality tables are relative. Okay, so for example, a country's mortality table is is the mortality of their entire population. It's a mix of insured population, uninsured population, young ones, rural areas, urban areas, different profiles. So the population mortality would be different from an individual mortality, because when you talk about individual mortality, you will be very specific. You'll talk about his or her health status, you will talk about his or her family background or family history of diseases. And the group mortality, here is what you will look at, that you'll talk about this group's mortality. So what are the data aspects of this group? What is the average age of this group? What is the average sum insured of this group? What is the occupation, nature of occupation of this group? What is the location of this group? So your mortality, you need to understand that there are different layers of mortality, and you would be interested in the mortality of this group. Moving to something very important, it's like not talking about the elephant in the room when you talk about death and diseases. We have all experienced something totally unheard of and a very difficult time in the world, which is COVID-19, the pre and post pandemic world. Yeah, we all have never been through a lockdown in our lives, and God forbid, never again. But yes, COVID-19 and the pandemic situation impacted the whole world, all the businesses, life insurance companies to a very, very massive extent. So, how did the world before and after pandemic look? Until 2020, the situation across various countries and their mortalities was fairly stable. It was fairly benign. In fact, a lot of countries were showing improvement in their mortality rates because of improvement in medical science. Nowadays, a lot of newer diseases, by the grace of God, science is making development. So diseases are getting newer solutions, newer treatments. People are enjoying higher living standards. But the flip side of this is that, fast food consumptions, sedentary lifestyles, that is also playing, a havoc in today's population across the world. So it was slowly ticking up. There was improvement in mortality, but it was kind of, plateauing. And then, bang, comes the arrival of COVID-19. This was a completely new source of mortality. There was no historical data, no experience whatsoever, as far as mortality is concerned. The world was helpless. Everything had to be shut down, locked down, right? We were all not even allowed to step out of our door. So this was like a complete, plenty of unknowns basically. So at that point in time, the mortalities also ensured different set of influences. There was a pandemic impact on the mortality tables as well. So yes, very, very important. I thought, before we talk about the actual age and gender, we discuss mortality and morbidity. So moving on, therefore, your group that you're looking at, the age and gender becomes the key character of deciding the price. So you cannot just utilize a data sheet and just run an average and take the average rate, because that would be inappropriate. Depending on the right way actually to do it is to have a proper distribution of age against the distribution of sum insured and the portfolio mix, because that will assist you in doing a fair pricing. You remember the picture that I showed you, the act of a well-balanced equation, price versus value. Only then you will be a successful underwriter. And how your data displays age is either you will get a detailed date of births of each member. At times you would get only the date of births due to confidentiality reasons, which is sufficient enough. Or if there are dependents, you would get age bands for the spouses or the newborns. What the pricing tool would usually do is subtract the year of birth from the current year and make adjustments for the upcoming lag on the policy effective date, because typically the mortality rates are based on something called as age nearest basis. Okay, what is my age nearest basis? So let's say somebody is 24 years and 8 months. Okay, he's more closer to turning 25, whereas somebody who is 24 years and 2 months. So the earlier example, we will consider his age nearest birth date, or we will consider him at the age 25, and your pricing tool will apply the mortality rate of 25. Whereas the second example, where somebody has completed 24 years and 2 months, he will be charged the rate of 24, because eventually, when you see the mortality tables, those are age based, and therefore it's critical to determine this. Your pricing tool should pick up the right age. Gender, we I'm sure you all have heard that females depict a better mortality, because that's how naturally, there are some cardioprotective mechanisms whereby females enjoy a healthier life. And there
Do
are
you,
tools where, yes, sir.
sorry, doctor. Why
Yes.
do you think the females enjoy better health than the males?
Right. I will come to that. So biologically, before the age of menopause, there are certain hormones in the females which prevent the female from having cardiac issues or early heart attacks, or there are some hormones which are safeguarding females from cancers. But to be very honest, as and when we are heading towards a better standard of living, more exposure to toxins, more refined products, we are losing touch with nature. So it's kind of, the female and male mortality is almost coming at par. But yes, the gender also becomes a very important aspect. And some pricing tools actually compute discounts based on the proportion of females,
Thank
right?
you for the explanation, doctor.
Thank you. So moving on, we looked at age and gender. Similarly, what is the nature of occupation or the industry class of your group? So typically it's class 1, 2, 3, 4. This is how usually occupation class is divided into. One being the most desired, like all of us, professionals working 8 hours in a very good environment, not really exposed to any physical harm or any physical hardships in terms of access to food or safety, right to the bottom of the table, which is skilled or semi-skilled, such as construction laborers or cleaners who are more into physical activity. So, whereas, there is a coding of class 1, 2, 3, 4, there's also an interesting color coding that happens, which is white collar, white and blue collar, and blue collar. So typically white collar are, as the name gives away, professionals, the class ones. Class two would be the white and blue collared, and then obviously the lowest would be the blue collared. So there are various studies done across the world which says that your education level and your social status is an important determinant of mortality, and therefore the occupation class and industry class should be well stitched in your pricing tool. And in fact, especially for the riders that we saw, the accidental deaths or the riders, they come with extra loading depending on the industry class or the industry colored. So this again, extremely important as a part of your pricing tool. Moving on to locations. Now, as I told you, think of a non-life underwriter. You're talking about insuring a standing building for fire or earthquake or a hotel or a structure, it's going to stay there for another 10 years, right? But your people, the beauty of life insurance is that your people are moving around. They are getting up in the morning, going to their work, coming back, aging over the years, developing diseases. So you are looking at a much more dynamic group, and therefore location becomes extremely important. Differences in locations, it impacts mortality. As I was speaking earlier, that education levels, income levels, there could be a group of factory workers who's very close to a polluted area. These people automatically will have a higher chance of developing a disease. Let's say there's extremely high industrial area, chances of a lung disease is much higher than somebody who's working in a much cleaner environment. So yes, expected mortality impacts because of the location. Technically, what you also as an underwriter makes a decision making impact is your event limits. You want to talk about the catastrophe exposure. Okay, are all my people working under the same roof? If there is an accident or there is a fire, are they going to die? How many losses do I expect? So it helps in deciding the loss event limits. It's a vital assessment tool for your risk accumulation. You want to be aware of your book, that okay, in which location I have the maximum exposure, because always you want to, from a specific risk, you want to pan out and look at your entire book, because remember the balancing act. You want to have a book which is sustainable, profitable, and stable for a longer period of time, because over the years you will reap the benefits of a good underwriting and a very fortified pricing. All right. So we saw age, gender, occupation status, locations. We move on to something simpler. Yes, of course, group size. No points for guessing. We are talking about law of large numbers. The larger the group, it's a well spread risk for you. It's a better group. A smaller group is always one claim and you're wiping out the entire premiums or the profits that would probably arise from this. So I think we can quickly move on to the next slide, because yes, definitely group size makes a huge difference. In fact, just before starting our webinar, Mr. Momin was giving me a very good example of how the rate sensitivity is so crucial depending on the group size. And once we were having a discussion with our pricing actuaries, and they kind of said that premium tweaking between a small group versus a large group, and how it actually impacts the actual claims experience. So yes, group size also becomes very critical. Moving on to a topic which probably could be held as a separate webinar at some point in time. I cannot underline enough the importance of health and lifestyle, not only for the group life insurance pricing webinar, but overall. We all know that health is wealth. If you want to enjoy a good life, you have to maintain a good health and a good lifestyle. And so is the case for our insured groups. So the health status of the employees is affects the group premiums. So remember, the pocket from where the money is coming, the insured, which is the corporate company, they will make sure that there is a healthy environment. They will make sure there are wellness programs running for the employees, so that it's a hand in glove situation. If you have healthy employees, if you have a very good working environment, automatically it is a cost saving for you. You will pay less as a premium, and it's a win-win situation. If you have too many people with chronic illnesses or pre-existing illnesses, obviously it's going to impact your premiums. Yeah. So yes, it becomes extremely impactful on the pricing of the group life insurance. Lifestyle, somebody who's a chronic smoker obviously has a higher exposure to, let's say, lung issues or cancer, so on and so forth. So moral of the story, health and lifestyle of the group becomes a massive impact on the pricing of the group. Moving on, we all discussed, we already saw this, that the nature of the product benefit impacts the pricing. Straightforward, it's a direct impact. So we already saw, is your product a group term product or a group credit life product? Is your product basic or there are riders to it? We saw the various kinds of riders that would get attached, and the definition, again, I repeat, the importance of the nature of the rider, the definition of the rider, the sum insured attached to the rider. Your tool has to be completely fortified with these aspects of the product benefit. If you falter in the morbidity rates, let's say for critical illness, you will have an impact on the performance of the scheme. Similarly, the sum insureds we already discussed. Look at the sum insured. What is the nature of sum insured? Is it flat? Is it salary based? Is it multiples of salary? What kind of outstanding loan balance are you looking at if it's a group credit life? Is it graded? Look, watch, be watchful, whether is the data making sense? The lowest employee group is not having the highest sum insured, because that's basic sanitation check that you would have as an underwriter. And yes, not to forget the FCL and the inclusion of dependents, spouses and children. So product benefits. Yes, sir.
Sorry, Doctor. I have got one question over the from the participants here, asking about particularly the FCL, the free cover limit. Can it be changed at the renewal of the contract or not?
So typically, FCL is a very sensitive area of discussion. To answer the question, yes, change. And usually the ask is for a higher FCL every year.
Of course, they will
So
always ask for a higher FCL.
yeah, so one has to again roll back and look at the holistic picture. So yes, FCL is something which is dynamic. It can be changed, but one has to look at it. Has your group matured into has the average moved from a X value to a Y value? Is your FCL request making sense? Or is it just, let's say somebody is asking for 5 million FCL and there's just one person in the group with 5 million. It's like you're directly asking for that person's free cover.
Yes, exactly. Yes. But if it is, Doctora, if we change the FCL upwards, do we at renewal, for example, from 250,000 to 500,000? Okay, I know that this will affect the pricing of the group for the renewal, but do we ask all the employees and dependents that are covered who are reaching this FCL to go through medical, or only the new enrollers?
Right. Thank you for the question, and thank you for bringing a very valid point. The beauty or the nature of the group life is, remember that it's a insurance is incidental, right? One is not staying in the group for enjoying insurance. He's just part of the group, and therefore, and so it's unfair that somebody, let's say the FCL was fixed at age 55, and somebody joined the company, and by virtue of he continuously being in the scheme turned 56. It's unfair for me to ask him, please go and do a medical checkup. No, because he is a continuous existing member. So we will not ask for proof of health or a fresh medical checkup for existing member. But yes, for a new member who is above the set FCL, we will ask for medical examination. However, the other aspect is, let's say he has recently done a pre-employment health checkup, which is satisfactory enough. It's just recent, within the last 1 quarter, and everything, all his checks and balances are in place. We are accepting that. We are not insisting to ask him to go for another blood test again.
Thank you
right?
so much indeed, Doctora. This adds a lot of clarity. Thank you.
Perfect. So we covered the various aspects of the group, and now I think it's safe to jump into the actual act of utilizing your well seen data, your well understood profile, and the entire product structure. Now you are clear in your mind as an underwriter, and you are ready to use the pricing tool. Typically, it's like a fork, it's like a three-step involvement. Your technical pricing has the below key important components that affect the risk. A, the underwriting information that you have, which is age, data, occupation, the first part of the multi-factors that we saw. The scope of cover, what is the product, what are the riders, and the exposure assessment. What is the mortality, the size of the group. Okay, so these three are the key elements that, or the components that affect the risk. And what is the input that you will begin to start with is entering the risk data, entering the exposure data, and of course, if it's a existing scheme, then you utilize the claims experience. So basically, why do you do a price? What is the idea of doing a pricing activity? It's a simple answer. You want to know how many people will die at the end of this, right? That is why you want to understand whether I am collecting the right amount of premium. Why as underwriters you want to collect premium is because, remember, you have delivered a promise. You want to price the promise. You want to price for the ultimate claims that you would finally experience in this group, and therefore you are doing this pricing. Always remember the motive why you are doing. Do not forget, don't focus just on the goal that I want to give pricing. Broker is asking me 1.5 per million and I will hook or by crook achieve that. No, as I said, look at it as an overall journey for arriving at the price. Okay, so we know that we are doing this activity to estimate the claims cost of the group. Now, very sensitive area as to, now you know the entire group, you have your mortality tables in place, you have your exposure in place, and now it's the time for you to estimate the mortality. It's like predicting deaths, in very plain Jane, crude words. So, what are the factors where your tool will talk about how to estimate the claim cost? Firstly, because you are predicting something, there is certainty and uncertainty. Whenever there is a high amount of uncertainty, you will try to put a lot of security margins in your tool, especially when you're looking at markets where there are no well established mortality statistics. It's a relatively new market. Or the other aspect would be, there are mortality tables, but you've done, there is a misestimation. You've not really appropriately understood because you remember I told you there is a population mortality, there is an individual mortality, and there's a group mortality. So where do you stand? Where do you estimate your mortality risks is important. Whether you're following the trends, some countries, some locations, or some groups, are their group size increasing, decreasing? We just spoke about it during the question related to FCL. So are you making regular adjustments of trend risk? But the good news, as we saw, that you can revise your pricing every year, right? So since your group term life or group credit life is annual 1 year renewable product, you have the chance and security to do it. But mind you, at times you also get requests for rate guarantees. So typically, that's the newer trend we are seeing, at least 2 years of rate guarantee. But in ideal situations, we do not operate on offering rate guarantees. So yeah, just to underline, minimize the risk of misestimation by ensuring that you're considering adjustments, following mortality trends, and using all the various rating factors such as occupation, geographical location, etc. Now that you have kind of assessed that this is what should be my thought process while estimating a claim, let's look at an actual example of computing the expected claims cost. So once your group mortality is set, for each individual, if you look at the table below, it's just, I've taken just a small snippet. You have these members, and the second, it talks about gender, whether it's male or female. It talks about the age nearest to their birthday. It talks about the individual sum insured. You can see here that each person has their flat sum insured. And then you have the base mortality rates along with adjustments. So for example, the lower two have the same rates even after adjustments. And then the product of the sum insured and the adjusted mortality rate is the claims cost for each of these members. But we are not doing an individual pricing. So your tool at the background runs all this. And at the end, you get the claims cost for the group. So the summation of all the participant members, you go through a granular level of running the mortality expectations on every single member, and then you arrive at the thing. You remember when we were talking about age, it's not as simple as you just take the average age and you run your pricing. No, you will go through each and every participant's functional characteristics and come across as a expected claim cost. Moving on, very critical aspect that we touched base upon is the currency in which you're operating, or the foreign exchange rates. At times, you may operate in various different markets or locations, and you would wonder why a foreign exchange is going to impact my underwriting pricing. It will, because, as I said, every morning we wake up, there is a news. So, for example, foreign exchange rate impacts on various geopolitical situations. We saw a couple of years back the Russia-Ukraine conflict. Before that, there was a huge blast in Beirut. Way back a couple of years, we saw a huge Turkey earthquake. So all of this kind of impacts the local currency, and it impacts your underwriting philosophy. It impacts your guidelines. If there is any fluctuation or devaluation of currency, you may, as an underwriter, have to revise the expected income that you would have probably reserved for at the beginning of the scheme, and by the end you saw that okay, there is a devaluation. So you need to be very vigilant about all these aspects and how your pricing tool is handling it. As I said, you would be operating on multi-currency policies. At times, some big corporates want to issue policies only as a US dollar currency. Importantly, as I said, that your renewals also get impacted based on the foreign exchange rate. At times, you would decide as an overall company that you don't want to work in a particular country because of the geopolitical situation. You don't want to renew business, or if the premiums are showing high fluctuation, you will adjust your ULR, which is the ultimate loss ratio calculations. You will say that okay, I'm not going to do a renewal because it doesn't make sense. There is no viability of business. So yes, foreign exchange also becomes a important aspect in your pricing tool. All right, so we move ahead. Yeah, this is a screenshot of how a typical pricing tool would collect all the preliminary risk details. You would look at the type of scheme, the nature of activities, number of locations. I think we could just go through it. This is just how structurally what we just spoke is inputted in the risk details input. Okay. Important. We saw in the picture related to the balancing act that you should know your product, you should know your consumer, you should know your market. And then at the bottom, you saw everything is working on costs. To run a business, to run an insurance company, to run a reinsurance company, you are putting in some money, right? So you have variable costs, you have fixed costs, and you have to definitely look for a profit margin. So what your tool, your pricing tool, will churn out these loadings as well to come up with a price. So typically, just for definition's sake, I have put some loadings or margins, which typically a pricing tool will incorporate. Expense margin, we all know there is a cost of acquisition of business. Underwriters have to have their salaries. There is a servicing team. So expense ratio is calculated by dividing all of these expenses by the net premium. Mind you, expense ratio becomes like a gold standard. It's a key piece of the combined ratio. We will see that eventually how it's calculated. And it's like measuring a company's efficiency, a company's profitability. Very, very key expense margin. ROC, return of capital, it's basically a measure of profitability. You compare a company's profits with the assets used to produce them. Then you have a profit margin that it's measured as a percentage of how much money a company is making on its products and services, of course, after subtracting all the direct and indirect costs that are involved in creating this money. Brokerage, we all know we pay brokerage to brokers as a percentage of the gross premium. In certain markets, there would be value added tax, or there could be a regulatory fee. For example, for instance, in the Kingdom of Saudi Arabia, there is a 15% VAT, and there is a SAMA fee, which is currently fixed at 0.5% on the gross premium. For us as a reinsurer, we also pay commissions to the seeding company. It's like to cover the seeding company's acquisition cost. So the point here is that once you talk about the actual exposure mortality rates, you also need to remember the lower half, which is your costs, your fixed costs, variable costs, and your profit margins to arrive at a correct price of your scheme. This is again, after you put your risk details, what is your exposure detail? So your exposure is basically your product. If you see on the left side, these are the various riders and what are the percentages which you are choosing. This is how a pricing tool would look like. And of course, the entire census data. I've just put up a screenshot for you to understand. So you will use gender, date of birth, age, industry class, sum insured. All these are basic requirements. Now, when you're looking at claims, you could have two kinds of claims. If you're lucky, you will have a detailed claims experience. You will have person by person claim experience, whether it was the date of loss, how much was the paid premium, when did the death occur, so the date of loss, when was the death reported, what was the cause of death, whether it was due to COVID-19. So you may be lucky as an underwriter to receive detailed claims. Perfect. This is the ideal situation. But at times, you may just receive the summarized claims experience. You would just receive the total sum insured, the total number of lives, and the total number of claims, and the amount of claims. So your pricing tool should be able to handle both these kinds of claims experiences, because this is the key to after you add your exposures, how the actual claims behavior is done, and then you conclude with your pricing. So just to give you an example of how claims would look at, what is the nature of claims that you would look at. In some markets, it's mandatory. So for example, in KSA, the current insurer, it's mandated for them to submit the claims experience on their letterhead, validating the actual claims. Okay. Now that we have all our data in place, exposure details in place, product details in place, it's time for doing the actual mechanics, which is the estimations in a pricing tool. Because remember that it's always an estimate. You cannot be always sure, right? You cannot always confirm that, yes, this group is going to have 10 deaths or this group is going to have 20 deaths. Next to impossible, right? Even if there is AI, which is sooner or later going to be the reality, it's impossible to predict. In fact, just to cut the session and on a lighter note, I used to have a senior in my previous organization. He was a qualified actuary. He used to joke about this word IBNR. It stands for incurred but not reported. He used to tell me reserving, Tanuja, is like working for the weather department of a place. You are never accurate, but as long as you can explain it with the right reasons, why you predicted sun or why you predicted rains, you can keep the job. So IBNR is an interesting aspect of the estimation of the pricing tool. We will not get into the theoretical ways of calculating IBNRs. Probably in the future, we could have an actuarial session. I would be excited to attend that. But there are various methods in which IBNR is calculated. Before we get into the IBNR calculation methods, what is IBNR? It's basically to reserve that you are sure that this is going to develop further. We saw that timelines is important for the data. Do you think the last bit of your claim has reached your table? So therefore, incurred but not reported, claim which is still in the pipeline. Mr. Momen, you want to add something here?
Dora? Yes, please, if you don't mind.
Yes.
I have I have not a good question. I have a question here.
Yes.
You have spoken about the locations, particularly of the group. So if the group is in the same place, almost in the same place, like a company or an organization in the same place, so they know immediately whether someone has passed away or not, versus like a bank that lends money
Absolutely.
to a huge number of people, and then they receive late notification that this person has passed away after a couple of months, perhaps. So does this affect the pricing or the calculation of the IBNR, the type of the
Absolutely.
group and the location of the census of the group?
Absolutely, absolutely, sir. In fact, this was one of the difficult aspects that we faced during pandemic situations. So yes, as you rightly pointed out, if we are talking about a credit life where by the time the borrower is dead and by the time the actual proof or the news of the death travels to the lender, versus somebody, as you rightly said, we are all working in the same office. And when an employee dies, obviously you will immediately know. And to layer it up with a lockdown situation, there is a lag that the news has traveled very late. So therefore, yes, it heavily impacts the IBNR reserving. And therefore, these are the various technical methods which are used to estimate IBNR reserves. And it's so critical to have this included while doing the pricing, because otherwise you're on a half-baked situation.
Thank you so much indeed,
Right.
Doctor.
So the couple of slides ahead, probably we could, so here, if you see the last point, it's a lag adjusted frequency. This is what we were just discussing, that a slide behind, we saw that you're lucky enough to have the date of loss and the date of reporting. So you know what's the lag between the event and the reporting. And many of the policy wordings have a claims notification period. Very important for us to understand, because if the claims notification period has crossed, then the claim is not tenable. You will allow, let's say, 6 months or 8 months for the final news to get registered that either the borrower is dead or the employee is dead. So this lag becomes very important. All right. Yes, I think the other estimations in the pricing tool are the benefits and the exposure. We have already discussed mortality and morbidity of different countries and class, why you should be updating it from time to time based on several studies and research papers, why age distribution estimations are important, because you need to understand the portfolio mix. The last point, pricing selection, again, interesting. There are two kinds of pricings which we will see: exposure and experience. So to give you a quick understanding of the pricing selection, experience rating, the name gives it away. What has been the actual experience of this claim? The larger the group, the more claims, the more detailed claims you have, the data is more credible, and you can actually know the actual performance of the scheme before the inception. So this is called experience rating, and you use the group's actual claims experience before even the next renewal term starts. Whereas exposure rating is typically used in situations where you do not have any past history. It's a new scheme, it's a virgin scheme. So what do you base your estimation on? You will base your estimation on the current exposure. That's called the exposure rating. You will use the current data, and therefore data becomes so critical to understand the exposure. So yes, all the factors that we discussed so far become a part of your exposure rating. And your final rating becomes a combination of your experience and exposure. That is where, as an underwriter, your experience, your years and years of seeing business, your judgment, and your gut feel of the market comes into play, right? So we can quickly just move into, these are some slides, couple of next slides, which are just for it's hardcore actuarial mathematics, but you should know it, because as an underwriter you should know the concept of severity. What severity means is what has been the claims cost, what has been the average size of your claim amount, and then you decide on the uh, high severity claims and low severity claims. So obviously claims which were more expensive than the average claim is a high severity claim. And then you select based on your inputs for the, so you have a data, you have an existing data, you have each year's claims, you do the weighted average of different years, and then finally you choose from your pricing tool the expected severity, mind you, watching all the other aspects of your risk. So that is one part of IBNR activity. The other part is claims over sum insured. You have the data of the incurred claims for the previous historical years, and then you come up with these factors, the average ratio. We talked about the lag in the ratio. So this is one aspect of utilizing the historical claims and a method of reserving your IBNR. Lastly, as I said, we could look at the last bit of here, that a burning cost or the expected claim before and after the reserving. And at the end of the day, it's the underwriter who knows the touch and feel of what is coming up as a figure, as an output from your pricing tool, that what do you think is the correct price, the fair balancing price. This picture is just for us to understand that yes, once the ages are calculated and across each age there is industry, what are the various benefits, and your pricing tool will accordingly calculate for each member based on his or her sum insured, based on his or her mortality and morbidity tables, the rates for every member. At the end, it will be a summation for the entire group. And then comes your final pricing. So again, just a pictorial depiction of, so you see the blue box talks about the exposure. On the left, the blue box on the right talks about the actual experience. And then the final rate is a product of all your costs, your management fees, your brokerage fee, and then finally in case you're buying reinsurance for the scheme, you will apply the loadings and come up with the combined final rate. Credibility factor is extremely important. The longer trail of claims you have, the better credibility weightage it gives. The larger the group, the better credibility weightage it has.
Dr. Tanuja, if you
Yes.
allow me, I have got here a couple of interesting questions from the participants. One of the questions is asking if we have a scheme that has been insured for a couple of years, right? And there have been death cases for certain reasons that we believe are non-recurring or hopefully will not recur, like in the COVID-19.
Correct.
When you do the pricing for renewal, do you exclude partially or totally these claims, or you consider them as part of the claims experience of the group?
Excellent question. Excellent question. In fact, this is going to be one of the key discussions that we will have. We can park that question, and we are going to talk specifically about the renewal underwriting. So yes, we will touch base upon this, and it's a brilliant question. That do you consider something which is out of the normal and penalize the group, because that's not going to happen. So pandemics are not going to recurrently happen. It's a catastrophe event, and therefore congratulations to the lady or the gentleman who has put up this question. It's the right thinking as an underwriter. Thank you very much.
Thank you so much indeed. I'm happy that also the participants are taking active, role in this discussion, so that it enriches also the discussion and benefits everybody listening.
We are all learning. It's a symbiotic environment.
I'm the first one learning, Doctora. Thank you so much indeed.
Perfect. I think we are heading towards just a closure. Yes. So this is a recap of the basic formulas that you would see as an underwriter. Loss ratios is obviously losses upon premium. Expense ratios, we saw it's the expenses on the premium. Combined ratio, which is the gold standard of your book's profitability, is basically the losses plus expenses upon the premium. And then you finally arrive at your underwriting profit. So for example, just a crude example, 100 minus combined ratio is your underwriting profit. Let's say the loss ratio is 70% and the expense ratio is 25%. So your combined ratio becomes 70 plus 25, which is 95%. This is the premium that you're using to pay the losses and the expenses of running the business. Ultimately, you have arrived at a profit of 5%. So just, for your basic crude understanding. Now, jumping to, now that we've concluded the pricing activity, very crucial is asking the right questions if you are doing the pricing of a renewal of a scheme. Now, first things first, we are here to retain business. Our primary objective is to retain our own business, because you have spent 12 months with the group. Who else will be able to better predict or better estimate the performance of a group whom you yourself have spent time on. So yes, primary objective is to always retain and also maintain the profitability. So ask the right questions. Was the initial information useful and correct? Is it still relevant? Do you think you have some new information available for the same group? Check on the trends of the group. Are there any additions, deletions? Have the sum insured definitions changed? Do you think there are new employees? So, we had the FCL question. Do you think these new employees are still within the FCL limits? Has the inclusion of new employees changed the distribution of benefit levels? As I said, always compare and contrast the past year's information with the current submission, and you will be surprised to see some very beautiful discoveries which will help you price better. Check for the trends, as I said, whether is it a steady, increasing or declining trend. That is the set of right questions that you should ask at renewal. Analyze the pricing. Okay, as I said, check for claims experience as a whole. Paid, outstanding, and IBNR. All aspects need to be considered as your pricing analysis. Check whether whatever you priced previously, how different or how far or near was it from the actual experience. Because when you do the renewal pricing, you are actually seeing, it's like you put a seed and after 12 months you saw whether it has deteriorated, whether it grew into a beautiful plant. You know how your mortality tables have worked. So it's in fact a very interesting activity to do renewal pricing. Check for the credibility data. This is the point that we just discussed. Maybe there were some catastrophe losses. Maybe there were 2 or 3 losses purely incidental due to COVID. So yes, that is one of the very big aspects of doing renewal pricing. Check for evidence of anti-selection. Check for the claims, what you got submitted. Are there any outstanding claims which are getting, have been kept on hold for some legal notice? Have they gone for some fraud evaluation? Check for these aspects of claims. Just don't go by the numbers that are coming to you as a data. Look for the story behind the numbers, and you will realize, the scheme just comes alive in front of you. Should I try to, recover from my past losses? Let's say, you are having a panic attack. Oh my God, I have underpriced it. Do I simply just load blindly? No, because by doing so, your sales team will be unhappy. You cannot hike up your premiums randomly. Go with a systematic approach. Because sometimes the poor experience of smaller groups, may just be a statistical fluctuation. So keep your eyes, ears, all senses open, to do a renewal pricing. Look for the timing. This is something vigilant. Look for the reporting delays. We discussed this. Look for changes, whether if you're going to give a new rate, is it a time sufficient enough for your client to accept that new rate? Is the upcoming renewal too close, or do you think you still have 3 months left and somebody is chasing you for a price? Wait for the claims to develop, because the timing is extremely important for you to understand the reporting lag, for you to come up with the IBNR reserve. Check, whether in the previous in the previous pricing, the first time pricing, were you overly optimistic about claims assumption, or were you, extremely pessimistic? What were your administrative costs? Did you take too broad margins? It's a good time to do this in reflections internally. At times, when you do renewals, you realize that as a company, you may want to modify some underwriting guidelines, or you want to change some procedures. The in the end, like, the difference between quoting for a new group and a renewal is marginal. It's just that you have more information available to you. And the best part, you already have a relationship with the client. So you know the inside story already while doing the renewal. All right. So as we spoke for the last, I don't know, more than 1 hour about what is correct, what is good, what is nice, what is must to do, I cannot not tell you about what is wrong, right? Because you should always see the both sides of the coins. Consequences of a bad pricing. As an underwriter, I should know what will happen if I do a bad pricing. Premium too low, premium too high. If I charge a very low premium, halas, I'm not able to pay claims. I'm not able to pay salaries, right? It's unsustainable. Remember the balancing act. You have not balanced it. Either your value has gone up or your price has gone up. So not a good equation.
True, Doctora.
If you, yes, sir.
And what you are saying, Doctora, was actually one of the biggest challenges we have, particularly
Correct.
when you experience a bad performance of one of the groups or schemes. And at the time of renewal, if you increase the rate by 50% or 100% to compensate part of the losses you sustained in the previous year, most likely the client will walk away. The group will walk
Absolutely.
away to another company. But at the same
Absolutely.
time, you don't want to keep the scheme and expect that, okay, this year also for the renewal, we expect it to make losses because we didn't follow the science, we didn't follow the actuarial or the mortality rates and the proper loadings and so on. And that was one of the biggest challenges actually. But you remember, Doctora, before we start this webinar, there was
Yes.
a side discussion where we distinguished between the very large groups, which I feel I don't feel very, comfortable underwriting. Perhaps because you are the underwriting manager and you know the bits and pieces of the underwriting of large groups. But the concern which I would like to share here is that when you write a very large group generating huge amount of premium that perhaps represents 50% of your book, if
Right.
this if the pricing of this group was incorrect and it went wrong, and perhaps the loss ratio was only 105% or combined ratio was 105%, perhaps this 5% losses will eat up the profit of the rest of the book. And then at
Absolutely.
the end of the year, the underwriting team will be doing a marvelous job and working very hard. But ultimately, at the end of the year, their uh, their department has generated losses to the company. So they will always be seen
Absolutely.
as you destroyed the profitability of the company because of the large scheme. So always the
Yes.
large schemes are very sensitive to pricing. Either if you price it wrongly, you will most likely end up in losses. And if you priced it very highly inappropriately, then most likely they will go and all of a sudden you will lose 50% or 40% of your book from one
Absolutely.
client. So always be
Absolutely.
very careful, particularly with the very large schemes. The
Absolutely.
smaller ones perhaps of less impact on the portfolio, because in a small group of 10 or 20 or 30 people, perhaps there will be one death or none. So you might
Absolutely.
make profit or you might make a big loss, but this is normal in the small and medium-sized groups. That's why if you if you if you plan to write small groups or medium-sized groups, try to make sure that you write a good number of small or medium groups scientifically, so that if you have a loss from one, it can be compensated by the profits or the premiums from the other groups. But one very large scheme or group can drive the profitability or losses of the whole portfolio the wrong direction sometimes. Doctora,
Absolutely.
before we
Thank you.
proceed, I have one question also from one of the participants, because
Yes.
actually we are approaching the time we have set for this
Yes.
webinar. But one is asking if he is a member in a group scheme. And for example, the scheme provides an FCL of 200,000, whatever is the currency. So he is now enrolled in this scheme without any medical health declaration or medical
Right.
proof of medical health.
Right.
If he requests an additional cover, individual cover, on top of the group cover that is provided by the employer for another 200, for example, and now with the adding of the 200 plus 200, he will exceed the FCL. Does it, if he requests this cover from the insurance company itself, where the group scheme is, does he need to go for a medical declaration or medical health proof? Or if he does it with another company, normally they will ask whether you have insurance policy with other companies, and then again they will consider whether he should go for health proof of health or not. Thank
Right.
you, Doctor.
Yeah. So yes, as we saw that the nature of the contract itself differs, right? So if somebody is a part of a group, okay, he is purely there out of his intent. So he is there. It's an incidental cover because he's an employee. He is a cover. So he has not opted for it. Neither has he paid for it. And when he changes his company or decides to exit the company, he will automatically, organically go out of it. And therefore, by virtue of the very nature of that group, he is enjoying a free cover limit because he is not in the group intentionally. When he tries to buy a policy out of his pure intention as a top up, that means he is the one who is going to pay the premium out of his own pocket. Whether he chooses to go with the same insurance company or whether he chooses to go with a competition insurance company. That's a separate contract altogether, and he will have to abide by the individual products underwriting guidelines. This is what I hope that clarifies.
Yes, thank you, Doctor. Thank you. So actually,
Perfect.
if for example, if he goes to another company, another insurance company, and there is still the amount he wanted to buy for individual cover doesn't trigger the FCL, normally he will be covered without health declaration, but or proof of health. But if he goes with the same insurance company, still he will be also exempted for, I mean, if the FCL is 200,000 for the group,
Yeah.
and so he is not going or providing any proof of health. But if he asks for from the same insurance company an individual cover, that will make it 300,000, which will trigger the FCL
Yes.
as both covers. Does it require the proof of health and should be considered in the pricing or not?
So yes, as an exposure bit, because he's going to die once.
Yes.
So as an underwriter, I know that my exposure is increasing, whether or not he is a part of. This is the risk accumulation that I have. So I know for sure the event, which is the death, which is going to occur only once, and my exposure has increased. So I will accordingly trigger. So,
Okay.
but in practical purposes, sometimes we get a request that okay, this is an existing client, existing member of a corporate group, and he wishes to submit a good health declaration, or he wishes to share a recent health checkup that he has done as a part of the corporate. These are some things that we as underwriters accept, and especially if it's a young life, and only by virtue of the sum insured he's crossing the FCL, we do accept these kind of exceptions.
Thank you, Doctor.
Yeah. Right. So to conclude, we saw the consequences of a bad pricing. A bad pricing is not the correct pricing, either a low pricing or a high pricing. Another loss or a consequence of a bad pricing is unusable data. You have lost the opportunity to create your own database, to create your own experience folders for the upcoming future experiences. You could have your own book of experiences or mortality tables to look at. And on the right side, this is a mind map. As you know that we are all working for different companies at different locations with different management team having their own strategy, their own organizational alignment, We are working in different governmental environments. You could have your own pricing experience, the way you want to execute your pricing. There could be tax and regulatory pros and cons, and the technology that your company is investing in, the way the data is getting managed. So basically, there is no right or wrong answer to tell that, you know, this is the way one should do pricing, because it's beautifully layered. And as an underwriter, you have to be fully aware of 360 degrees aspects. As an underwriter, you should have eyes in the front and back while you're doing the, you know, pricing. Suddenly, some thing changes as a tax benefit. Okay, your pricing approach will change. So yes, there is no right or wrong answer. As I said, this is an entire journey which you should focus on to, and once you complete the journey suitably, you will arrive at the correct price or the apt suitable price for your risk. Okay, so just to conclude, since we are a reinsurance company, I thought it's a good idea to put up this. This is the quick glance on the reinsurance arrangements. And typically, if you see the top part, it's divided into facultative reinsurance and treaty reinsurance. So today's pricing activity that we saw is typically for the facultative reinsurance, because each group is different, each group is unique, and each data is unique. So therefore, it's a facultative group life insurance pricing session that we did. For the benefit of all, I have tried to put up a quick glossary, because we used a lot of short forms and terminologies. I think this will come handy, you know, in case you want to go through the presentation. At the end, I have the pleasure to just put up our team's composition. Here you will be able to find out our contact numbers, our email addresses, our details of our capacities for life and risk. And, you know, we are open. We invite you all to connect with us for any reinsurance relationship that, you know, we could develop. We would be more than happy to, you know, incorporate your requests and build a relationship. I think that is all from my side, sir.
Thank you so much indeed,
Thank you.
Doctor. That was great, and I personally learned a lot, as always, when we were working together. I always had the pleasure to sit and discuss with you and the actuarial team. And I just would like to share one a quick story here, where I went wrong. Actually, I met the actuary for the pricing of a very large group, and we were actually very concerned that this group will walk away because we we needed to increase the price. And my discussion with the internal actuary was that can't we reduce the price a little bit so that the client does not go away? So, since we will have very large number of lives insured in the scheme, more or less it will balance each other. So if we go below the technical rate a bit, we might make profits, and then we don't lose the client. And actually he said like that, no, this is wrong, because we can do that with a small group, because in a small group, for example, if you charge 50,000, whatever is the currency as a premium, it will not differ much from 50,000 to 55,000. You know, if you increase the rate by 10% or lower it by 10%, it will not affect much the profitability if you have a 1 million claim. But because you might be lucky, so nobody will die and you will make profits, or someone will die, so the premium of 50,000 or 55 will not change totally the story if you have to pay a claim of 1 million. Whereas in a very large group, when you have too many lives insured, the rating becomes very sensitive, to the extent that if you go below the technical rate, you are most definitely will hit the wall and will sustain losses, because now the law of large numbers apply. So you are certain that approximately 10 lives will be lost, and the 10 lives might cost so much. So if we go below the technical rate for a very large group, most likely the company will end up in losses. Whereas you might be with a smaller group, very small groups, you might be lucky or you might be unlucky. But of course, every company will have its own direction and strategy. And sometimes the very large amount of premiums blur the eyes. It becomes very, like exciting. I should bring this scheme to my book so that I complete my budget and,
Yeah,
hopefully end up in profits. But actually, the science says differently. If you have a very, very large group and you price it wrongly, most likely you will make losses. But if you miss the correct pricing for a very small group, you might be unlucky and make losses, or you might be lucky and you will make profits. But the sensitivity of pricing, technical pricing for a very large group is very, very sensitive, whereas it is not that sensitive with the smaller groups. And one of the discussions we had, if the client wants, for example, or he pushes hard for a 5% discount, and we feel that, okay, we can accommodate like 2% or 3%, then perhaps we should initiate a discussion with the producing broker to also compensate
absolutely,
the difference,
absolutely,
because
yes,
it's not only the insurance company,
absolutely.
you see. So okay, we'll tell him, okay, we'll offer the 5%, but it will be 2% from our rating and 3% from your
Brokerage,
brokerage, because otherwise, if we reduce the 5% from the technical rate, we'll definitely make losses. But it is also in the interest of the producing broker to maintain the book and maintain the relationship with the client. So sometimes you need to use these like techniques to
absolutely,
ensure that you will maintain the account and at the same time you will make decent profit at the end of the year.
yes.
Doctora, I mean, it's never enough to talk to you.
Yeah, yeah,
Perhaps
yeah.
perhaps
No,
we'll schedule
what you,
another
yeah. This is the classic
perhaps we'll
example of
schedule
the
another one.
pricing outside the pricing tool. This is the classic example of
Thank
doing
you
the
so much
pricing
indeed.
outside pricing tool.
So thank you, Doctora. But actually, perhaps we will consider to take this discussion to the next
Yes,
level. So perhaps we'll get more complicated. Now we are done with the introduction and with the data validation, with the reliability of the data, understanding the client. So perhaps the next session will perhaps present the pricing tool, how some of the weird data appear when you receive it from the clients, how you deal with that, how you consider that in the pricing, whether you eliminate some of the weird information if we cannot get better or clarification of this information, and so on. So perhaps we will schedule another
another
next
session.
level
Yes,
presentation in the near future, inshallah.
inshallah.
Dr. Tanuja, I'm grateful for you. I'm grateful for Saudi Re for giving us this opportunity to share this experience. And if you don't mind, if you allow us, of course, we will wait for your permission. If we can share the presentation with the magnificent participants who have been with us during this session, it will be great from you. And
Certainly, certainly, sir.
we look forward to another wonderful time to spend and learn something more from your rich experience.
Thank you very much, sir. Thank you for the opportunity, and I thank you all the participants. I genuinely hope that this discussion will help you in better insight in what we do as underwriters. I'm glad and I'm thankful that you attended today. And let me take this opportunity to wish everyone a blessed Ramadan Kareem to all.
Thank you.
Lots of love to all. Thank you so much. Thank
Thank
you,
you so
sir.
much indeed, Doctora. Shukran jazeelan. Really appreciate your time and sharing this experience. God
Thank
bless you.
you.
Shukran.
Thank you.
Assalamu alaikum. Thank you. Shukran. I would like also to thank all the participants for being with us and for sharing some of the very valuable questions. And we look forward to seeing you again in the next level of pricing of group life and credit life. Thank you, and Assalamu alaikum, and Ramadan Mubarak to all.
Walaikum salam. Thank you, sir.
Shukran. Bye-bye.